But one thing Bitcoin has done is, in the face of bad news, the Clarity Act going from let's say from 40% all the way down to 17 for this year. And at the same point that strategy has sold Bitcoin. And not only has it kind of hung here, it's getting close to making new kind of short-term highs. So I'm a believer right now that all it's going to take to get the Bitcoin crowd fired up is a technical breaking point. I think this is the beginning, and I think we're going to look back at the last 2 weeks as being an indication that we're running this AI trade hot. We're spending lots of money, except we're not creating the jobs that we need. And the yen intervention is a representation that we have no more tools left.
It's a most dangerous moment for a central bank when the economy starts breaking in places it can no longer easily fix. That may be where we are now in the United States. Jordi Visser sees a Federal Reserve increasingly trapped between a weakening labor market, enormous fiscal deficits, stubborn inflation, rising long-term yields, and a Japan that has become too important to the global bond market to ignore. And when the world's major policymakers start coordinating to stabilize the yen while long-term borrowing costs are pushing higher, the question isn't simply what tool the Fed will use next. It's whether the old toolkit is still powerful enough to matter. And yet, against that increasingly hostile backdrop, Bitcoin is doing something Visser finds particularly significant. It isn't collapsing. Despite the uncertainty surrounding the Clarity Act, companies like Strategy and Marathon selling Bitcoin, despite macroeconomic pressure, and despite the broader risk-off environment, Bitcoin has continued to hold its ground around the $65,000 area and is beginning to approach short-term highs. For Visser, that resilience could be telling us something important. The market may be getting closer to the point where Bitcoin needs only one technical catalyst to reignite momentum. Stay with us, because we're going to unpack exactly why Visser thinks policymakers are running out of room, why AI could make the labor market problem much more complicated, and why he believes Bitcoin could eventually become one of the major beneficiaries. If you find this analysis useful, hit the like button, subscribe to the channel, and turn on post notifications so you don't miss our next market breakdown. And let us know in the comments, do you think Bitcoin's resilience is signaling the beginning of another major move?
Okay, so long-term yields were going higher, but then on Friday, after the market closed, the most important thing that I don't think has gotten enough attention occurred, where the U.S., for the first time since 1998, that same year with LTCM, coordinated with the BOJ to intervene in the yen. And this has all the hallmarks of desperation. And when you read through it, sometimes things happen like, okay, we're going to bail out someone. We're going to cut rates. We're going to create a facility for Silicon Valley Bank. They're very clear. You don't have to read between the lines. It's meant to stop panic. In this case, why would the U.S. intervene with Japan on dollar yen, which has been weaker now for a while, and the BOJ has been intervening? And everyone has gotten back to the fact that, what also happened last week? We made 20-plus year highs in 30-year yields in the U.S. The bond market has, for the last 2 years, been the line in the sand with the administration. This happened during each of the the dislocations we've seen, particularly Liberation Day, where saying we don't care about the equity market, everyone's just panicked for a little bit. But once rates start moving higher, we have an issue. And remember, this all has to do with the fact that we still have a huge deficit, and you can't have rates go higher. So on the one side, he's been arguing for short-term rates to move down. Well, now he's got Warsh. And on the back end, we have 30-year rates moving higher. And who's a large holder of 30-year rates? Japan. So you put all those together, and then I look for the market reaction. So Monday morning opens up. I'm buying silver again. And I want to see how this stuff trades for the week. I want to see if my intuition is right, which is, well, if you're not going to let bonds fall, you're basically going to be doing some form of printing. Then we get the refunding announcement where there's no change, which basically says game on to me, meaning there's nothing we can do. Then you get a labor report today. And I just want to tell people, because I'm sick of listening to economists talk about the labor market like it's strong and us sitting there. Wages have been falling continuously. Today's report was weak across the board. Not only was it weak, when you take the aggregate payroll, which takes into account the hours worked, the wages, and the number of people hired or fired, and you look at it over the last 6 months, so not 3 months, not 4 months, 6 months, we are at the weakest level since 2012 on a 6-month rolling basis, except for during COVID. So what that tells me is we're running out of policy options to deal with this. But the one thing I'm certain of is if you're not going to let rates fall and you're trying to, from the Treasury perspective, say to the Fed that we want you to use the repo facility for Japan, this FEMA side, and we want you to get rid of the cap, even though I'm sure this is him trying to enable Japan to be able to buy treasuries. I think what everyone should realize is we are at a critical point where the labor market is obviously on the weaker side. I've talked about the inflation swaps being way below 10-year rates. So you've got wages declining still, and today's hourly earnings now puts year over year at 3.2%, easily the weakest of this trend. I think we're at a problem because the AI agents are coming. So far, this has been a hiring issue. I don't think we're going to see massive layoffs. But I think what we've reached a point as is there's still more than one tightening built into the market before the end of this year. And amazingly enough, as we come on here, there's still a 44% chance of a hike in the September meeting. Now, a lot of that has to do with the inflation data, which is going to come out next week. But my body is responding to one thing, which is gold is breaking out, platinum's breaking out, silver's breaking out. Bitcoin hasn't broken out yet, but that's because the Clarity Act has been this overhang on it. But one thing Bitcoin has done is in the face of bad news, the Clarity Act going from let's say from 40% all the way down to 17 for this year. And at the same point that strategy has sold Bitcoin. And not only has it kind of hung here, it's getting close to making new kind of short-term highs. So I'm a believer right now that all it's going to take to get the Bitcoin crowd fired up is a technical breaking point. And I've talked about the fact that for me, when Dogecoin breaks above the 20-day moving average, the 50-day moving average, when we see starting breaks in the retail side, I think this is the beginning. And I think we're going to look back at the last 2 weeks as being an indication that we're running this AI trade hot. We're spending lots of money, except we're not creating the jobs that we need. And the yen intervention is a representation that we have no more tools left. So we're running hot into a scarcity of tools for the Fed.
Visser's argument ultimately comes down to a policy dilemma that is becoming increasingly difficult to escape. On one side, policymakers need to keep inflation under control. On the other, they are facing a weakening labor market, enormous deficits, and a bond market that is already pushing back against the cost of financing that debt. Meanwhile, Japan matters because it sits at the intersection of currencies, treasuries, and global liquidity. If authorities cannot simply allow long-term yields to rise indefinitely, they may eventually have to find another way to support the system. Visser is not arguing that Bitcoin has already broken out or that a rally is guaranteed. His observation is more subtle. Bitcoin is surviving conditions that should have produced much greater weakness. Gold, silver, and platinum are already responding to the changing macro environment, while Bitcoin has been held back by regulatory uncertainty. But if that overhang begins to disappear and Bitcoin clears the technical levels Visser is watching, the market could suddenly have a reason to move. But there's an even bigger force behind Visser's outlook, and it goes beyond the next Fed meeting or the next inflation report. He believes we're entering an economic environment where AI itself could fundamentally alter the relationship between growth, employment, inflation, and monetary policy. And if that transformation arrives faster than policymakers expect, the Fed may find itself needing to respond to an economy that looks strong on the surface, while becoming increasingly fragile underneath.
What do you think the Fed should do?
I think they have no choice in the matter. As far as I'm concerned, I'm going to run with you got to keep this train running. There's no way to stop this train. The whole Lynn Alden, viewpoint on this. When you still have a fiscal deficit of 5 to 6%, You've done as much as you've had. You've had all of this growth in equities and all of this stuff happen. We're not creating jobs. I don't know how to say it. We haven't talked about this before, but the labor participation rate is falling, and it's falling sharply. People need to stop listening to economists who are saying we have to raise rates, we have to do this, we have to go through it. We are on the beginning of AI agents, and if there's one thing every single person, including myself, maybe not you because you're not an optimist, you're like an uber optimist, has underestimated, is how much impact AI has quickly. Like when it starts to have an impact, it goes quickly. And I think the job situation now is starting to become a bigger thing where it's not going to replace jobs. But I just don't think that when you have labor participation, the supply of labor going down and wages are not going higher, I think they need to be on hold, but they need to be able to control the back end. And that's a very difficult thing to do when nominal GDP is strong. Let me go back to now using Japan and the US on this, because there's a relationship here. When I was in Japan in 1998, Japan was the only debt game in town. Everyone tried to short JGBs. It was called the Widowmaker. That's the whole point of this. Well, now here we are, fast forward 30-ish years. The US is in the exact same situation as Japan. The debt to GDP may not be the same level, but now we have a situation where Japan has inflation. The US has inflation. Is it runaway inflation? Absolutely not. Is it inflation? Yeah, it's higher than this 2% target or whatever people want to get involved in. So to your point, and to everyone listening, the reason that Bitcoin matters now, the catalyst that has happened is the fact that the United States government intervened by selling euros to buy yen. And you have to go through all of the reasons that they did this. The stabilization fund, they can't do anymore. We're running out of tools. And when you run out of tools and the refunding announcement comes out, you're actually at a point where we have to reflate our way out of this. So use gold as like a trigger point. And the way that I like to look at markets are, what happened last week? Well, the market on the macro side is saying, we got to buy gold, we got to buy silver. Bitcoin is going to fit into this. It's going to take a little bit of time, but I keep going back to the same theme over and over again. AI agents are the theme of this year. The theme of next year is consumer agents, which means transactions and volumes using stablecoin. That is going to happen regardless of the Clarity Act. And I actually think the Clarity Act officially being quote unquote done for this year, we've heard that the SEC and the CFTC is immediately going to come out with ways to basically supplement that. Maybe that's the catalyst that gets this thing going and it just starts going at that point.
The fascinating part of Visser's thesis is that Bitcoin doesn't necessarily need the economy to become healthy in order to win. In fact, his argument suggests almost the opposite. If governments continue running enormous deficits, if long-term yields become increasingly difficult to control, if labor markets weaken while AI accelerates productivity and displaces demand for human labor, and if policymakers are forced to keep finding ways to support the system, the pressure for some form of reflation could continue building. And that's where Bitcoin's position becomes increasingly interesting. If the system remains stable, Bitcoin can benefit from growing adoption, institutional participation, stablecoin activity, and the expanding digital economy. If the economy weakens, policymakers may eventually be forced toward easier financial conditions and renewed liquidity. And if debt becomes so large that governments simply cannot tolerate the interest burden associated with it, the incentive to keep real financial conditions from becoming excessively restrictive becomes even stronger. Bitcoin doesn't need every scenario to be bullish. It needs the monetary and financial system to keep confronting the same structural constraints. Then there's the AI variable. Visser's point about AI agents may prove to be one of the most important parts of this entire discussion. The first phase is about AI changing how companies work. The next phase could be about AI agents participating directly in economic activity, making transactions, moving money, and interacting with digital financial infrastructure. That creates a natural bridge toward stablecoins, digital assets, and eventually Bitcoin itself. In other words, the same technology that could disrupt traditional employment could simultaneously accelerate the transition toward an increasingly digital financial economy. Perhaps that's why Bitcoin's current resilience deserves more attention than its distance from the all-time high. At roughly $65,000, Bitcoin is nowhere near the historic highs around $120,000. But Visser isn't claiming that it is. He's pointing to something potentially more important. Bitcoin is refusing to behave like an asset that should be breaking down. The regulatory overhang may be fading, the macro environment is becoming increasingly difficult for policymakers to manage, and the technical picture could eventually provide the spark that turns resilience into momentum. The question now isn't simply whether Bitcoin can return to its highs. It's whether the forces building underneath the global financial system are creating the conditions for an entirely new leg higher. Because if Visser is right and policymakers are increasingly running out of conventional options, then Bitcoin may not need the perfect economic environment to thrive. It may simply need the system to keep proving that its old solutions aren't enough. If you enjoyed this breakdown, hit like, subscribe to the channel, share this video with someone following Bitcoin and macro markets, and turn on post notifications so you don't miss the next one. Thanks for watching, and we'll see you in the next video.